The Enron scandal, unveiled in 2001, stands as one of the most infamous cases of corporate fraud and malfeasance in history. The collapse of Enron not only led to significant financial losses for employees and investors but also prompted a re-evaluation of regulatory standards and compliance measures within the corporate world. This article examines the Enron scandal through the lens of modern compliance standards to understand how current regulatory frameworks might prevent a similar catastrophe. Overview of the Enron scandal. Enron Corporation, once a giant in the energy sector, engaged in extensive corporate fraud and corruption. The company's downfall was primarily due to its use of off-the-books special-purpose entities, SPEC, to hide massive amounts of debt from its balance sheets, allowing it to present a financially robust facade to investors and analysts. Additionally, Enron's executives employed complex accounting gimmicks like mark-to-market pricing, which involved recording potential future profits as actual profits. Key issues exposed by the scandal. 1. Lack of transparency. Enron's financial complexities and deceptive practices were obscured by a lack of transparency in its financial reporting. 2. Conflicts of interest. The company's auditors, Arthur Andersen, played a dual role as both auditor and consultant, which led to significant conflicts of interest. 3. Regulatory loopholes. At the time, regulatory standards did not adequately address the risks posed by SPACs and other off-balance sheet vehicles. Modern compliance standards and Enron. If Enron were judged by today's compliance standards, several modern regulations and practices could potentially have mitigated or even prevented the fraud. Sarbanes-Oxley Act, SOX, enacted in 2002 in response to the Enron scandal. SOX significantly tightened transparency requirements for public companies. Key provisions such as the requirement for CEOs and CFOs to certify the accuracy of financial statements, and the enhanced roles of audit committees, could have served as deterrents against Enron's fraudulent practices. Increased auditor independence. Modern standards enforce stricter auditor independence requirements, aiming to avoid conflicts of interest. These would have prohibited Arthur Andersen from providing both auditing and consulting services to Enron. Enhanced disclosure requirements for off-balance sheet entities. Current regulations have tightened the rules around SPECs and other off-balance sheet entities, requiring detailed disclosures about their nature and financial impact on the company's books. Whistleblower protections. Modern compliance laws include stronger protections for whistleblowers, which might have encouraged more Enron employees to come forward sooner about the company's practices. The role of corporate governance today. The emphasis on corporate governance is significantly stronger. Corporate boards are expected to be more proactive and involved in overseeing financial reporting and compliance. Governance frameworks and best practices now stress the importance of ethical leadership and corporate responsibility, advocating for a culture of transparency and accountability. Conclusion. Through the prism of modern compliance standards, the Enron scandal underscores the critical importance of robust regulatory frameworks and strict enforcement in maintaining corporate integrity. The reforms instituted post-Enron, particularly through SOX, aim to cultivate an environment of thorough financial scrutiny and greater transparency, minimizing the risk of such frauds reoccurring. By continuously evolving these standards and learning from past failures, the corporate world can better safeguard stakeholders' interests and uphold public trust in financial markets.